Now, the last topic which we have to talk about in future is actually two small little topics here. One topic is ban period. Okay, ban period. What is ban period? Because you may come across this term or this thing here, and then you may wonder, sir, what is this? You never touched upon it. So I'm just quickly touching upon it. Now you know the total number of shares in a company. Okay, majority of that is kind of held by promoters, right? Maybe. Okay, then a bigger portion is held by mutual funds, insurance companies, FIIs, which means institutions. Okay, banks, etc. And then some portion is held by the retail investors. Okay, now out of that portion also, actively, it's not necessary that all the shares trade on in the markets. So generally the volume of the shares which are traded in the market versus the total number of outstanding shares in the company is very less. The number of shares which are traded on a general day in a company versus the total number of shares outstanding in the company is very less, because promoter holding anyways will be staying untouched. It will never come to the market for dealing. And most of the institutions who have bought, they have bought for long term, so it will not be part of the general trading. So the small little retail portion or a very small portion is generally traded in the market. Now, if the total open interest, mind it what I'm saying, if the total open interest in the particular contract, in the particular stock, let's say, exceeds a particular limit, okay, which is called market wide position limit, okay, MWPL. If it exceeds a particular limit, now who decides this? The exchanges decide it, NSE, BSE. So exchange will decide what is going to be the market wide position limit you are going to allow in any stock. Okay, that market wide position limit is calculated based on the total number of shares which are freely available and which are traded on a normal day on the average, let's say last few 30 days or this, that. The exchange has their own mechanism of calculating it. I'm not going to go into that. Okay, what we are trying to understand here is that the total number of shares or contracts which the exchange can allow cannot obviously exceed the market wide position limit, which means, suppose can you kind of just think of this, that a company has 100 shares and you have opened derivative contracts more than 100, and now if the delivery becomes compulsory, then where will the shares come? Those have not been issued also, how will they come in the market? Correct? So there is always a smaller portion of compared to the total number of shares the company has in their balance sheet. Compared to that, there is a very smaller portion of shares which are traded, and of that also a smaller portion is treated as market wide position limit calculated by the exchange. And when the open interest in a contract of all the months, including the current month, next month and far month, in case of futures plus options both, when the open interest of all future and option contracts of the current month, next month and far month exceeds or touches 90% of the market wide position limit, then immediately the exchange halts trading in that particular derivative of that particular stock, in the derivatives of that particular stock. Now, when you say halts trading, you may confuse or get kind of a different meaning to that. So don't get a different meaning to that. When I say halting, it doesn't mean that you cannot exit or square off or offset your existing positions. Halting means brakes would be applied for creating fresh new open interest, which means all the existing people who have gone long and short, they, if they want, they can square off individually their trades through each other, okay, and bring the open interest down. But fresh people, either single or couple, both will not be allowed to enter the ballroom.